Understanding a charitable remainder trust. The benefits of a charitable remainder trust, known as a CRT. These are usually used because you have an ultimate desire to make an afterlife gift to charity, and you own an appreciated asset, land in this case, and we're just going to assume that the cost basis on the land is $100,000 for this example. If the land is sold today for $1 million, capital gains on the $900,000 would be due. 15% of $900,000 is $135,000. This money is gone immediately for taxes. Using a CRT, by creating a CRT and then gifting the land to the CRT, now when the land is sold for $1 million, you can invest the entire $1 million with no capital gains taxes due. So the results is you invest $1 million to produce income on that full value. This receives a tax deduction for the gift as well, meaning the family would receive a current tax deduction, and you can also deduct additional deductions for up to a total of 6 years, current plus 5. Family, the donors, you receive income for life as well. And charity, after the death of all, will receive what remains, hence charitable remainder trust. So some of the pros, of course, you're going to avoid capital gains taxes. You'll receive an immediate tax deduction for current years plus up to 5 more. You'll avoid estate taxes, so if you was in an estate tax situation, this land is now out of your estate and not used for calculation toward the value of your estate. You can avoid federal taxes, and you can provide additional personal tax deductions depending on your situation. You'll want to get advice from your CPA regarding these deductions. We can provide documentation that will help your CPAs if they're not familiar with charitable gifting. The cons, of course, is it's irrevocable. Once you create a charitable trust, it's irrevocable. The remaining value after the death of all living beneficiaries will actually go to charity. There are some changes that you can do in a charitable trust. You can change the charities as many times as you like, and under certain circumstances, and if this is in the verbiage of the trust, you can change the trustees. So setting up a charitable remainder trust is pretty simple, actually. A CRT is much like a regular trust, only a CRT has a donor, not a grantor. Trustees manage the assets and distributions of the trust assets, and the trustees may be the donors themselves or someone that you've appointed, i.e. family member, CPA, attorney, etc. The CRT must have its own tax identification number. So this will be necessary once the trust is formed. Now there's a few types of charitable trusts, so I'm going to cover just a few of them. The first one is called a CRUT. This stands for Charitable Remainder Unit Trust. Income payouts are based on the trust value. So when the trust is formed, it is determined what percentage will be paid to the income beneficiaries, and then this percentage can never be changed. For example, the percent must be a minimum of 5% annually. However, it can never be more than 50%. Now that's pretty extreme and pretty liberal, and there's reasons why you probably would not want to elect too high a percentage. For one thing, it reduces your charitable deduction, but we can discuss that in person. This percentage is based on trust value each January 1st. So either December 31st or January 1st, whatever the value is of that trust would determine the payout for that year. Example, if you set a 5% payout, whatever the trust value is, at the end of the year or the first day of the next year, your percentage, the 5% or 6% or whatever, is based on that value. Now, a charitable remainder annuity trust is a little bit different animal. This is for people that say, we're making the gift now, but we want our level payment every single year as long as we live. Hence, they call it a charitable remainder annuity trust. It has nothing to do with a true life insurance annuity, but the term annuity means level and consistent in this case. This type of trust will pay a percent of the initial trust value for life. So example, if you donate $1 million and you want 5% per year, that'll pay $50,000 a year, every year, to the income beneficiaries as long as they live. The payment must be the same, even if it reduces the original gift amount. So you can draw down your principal if it's not earning enough to keep up. Therefore, you can also adjust the 5% up depending on how many beneficiaries and the ages to determine how long it will pay you. The NIMCRUT, which is a net income makeup trust, is a little bit different again. The payout rules still apply. Must pay out a minimum of 5%, no more than 50%. However, to determine the payout amounts, the assets are valued at the beginning of each year. This predetermined percentage that you've decided on will pay only from the trust net income. The net income. So if the net income is insufficient, the deficiencies will not be made up from principal. However, the deficiencies may be made up in the future years if there is income in excess of the amount needed for the regular payments. This is a little bit deeper and not as consistent for people who want to count on regular income. Some of the rules regarding CRTs. There are non-charitable beneficiaries. This is what the donors or the people that the donors have named to receive the gift, the annual income, while they are alive. It can also be done for a specified number of years. The charitable beneficiary is the other beneficiary, which must be a 501c3, which is usually a church or a charity, March of Dimes, Cancer Society, etc. They must have a 501c3 for you to receive your tax deductions and tax credits. The trust must pay out a minimum of 5% annually and not more than 50%. Again, we can discuss this further, but the 50% would mean that you would be reducing your tax deductions and creating a flow-through of capital gains taxes to you at a much higher rate. So this would want to be discussed. There are multiple non-charitable living beneficiaries possible. So you can have 1 or you can have 5 or 7. This is the living income recipients. And you can have a number of charitable beneficiaries. So if you like the March of Dimes and the Catholic Church and the Boys Home, you can name as many as you like and for the percentages that you desire within this trust. Most CRTs pay first to the non-charitable beneficiaries, the donors, or whoever the donor names, and then the 501c3 will receive the remaining assets on the death of the living beneficiaries. This is the main rule. If you donate $1 million today, the original 10% of that original gift must eventually go to charities at some time in the future. So depending on how you invest your money, you could end up quite a bit further ahead, of course. Some steps to set up the Charitable Remainder Trust. First of all, you need to set up a trust. Have an attorney draft your trust for you. Then you need to obtain your tax identification number. Then there must be a donor name, so whoever's making the gift. So if there's 4 or 5 brothers that own the land, it'd be 4 or 5 brothers that would be named as the donors. Then you need to decide who's going to manage a trust. This would be the trustees' names, and you can have alternates. For instance, Bob and Walter, and if something happens to Bob, it'd be Walter and John, etc. Charities must be identified at the time the trust is created. However, keep in mind with verbiage in there, you can change those charities anytime you want. And then the income beneficiaries must be identified. So if this is 5 siblings, you'll want to name all 5 in here as the recipients. Step 2, assets valued and transferred to the trust, and then any sale from those assets will bypass capital gains taxes, therefore allowing you to invest 100% of the money. So assets valued to determine the gift value and the income payout. 100% of the sale is invested to generate income stream. And then the tax deductions. It's important to remember that, of course, if your gift is $1 million, you will not be able to deduct the full $1 million. Why? Because you're going to receive income back over your lifetime. Therefore, the tax deduction is calculated based on the amount of the gift and how much you may receive in income over your lifetime. Here again, you'll want to use your CPA, or we can provide documentation to help your CPA with these calculations. Next, the tax deductions may be realized for the current tax year and up to 5 additional years. This tax deduction again must be calculated by a CPA or licensed tax accountant. My name is Michael Eberhard, and I am Lifetime Solutions in Arizona. The address here and the phone number is actually my number, rings right into my home anytime, so feel free to give me a call. I hope this helped a little bit. We can get into more details later. However, thank you very much, and I'll talk to you.